Here's a number that's going to stop you. $450,000 in one ETF, the MLPI ETF from NEOS, pays you roughly $5,400 every single month. That same $450,000 in SPY, $385 a month. Same money, wildly different result. So MLPI wins, right? Case closed? Not even close, and here's why. Most people start by asking which fund is best. That's the wrong question. The right question, the one smart investors in their late 30s and early 40s actually ask, is this: what job am I hiring my money to do? Think about it. If you're in your late 30s or early 40s, the money situation is complicated. Mortgage, maybe daycare, a 401k you've been contributing to but haven't really looked at in a while. You're not retired, you're building, and the job your money needs to do right now might be totally different from the job it needs to do 15 years from now. Income now and growth later are two different jobs, and the fund that wins depends on which job matters most. So that's what this video is going to show you. MLPI, SPY, and QQQ side by side on a $450,000 investment. Income, growth, risk, and by the end, you'll know exactly which one fits your situation. If you had $450,000 in one account right now, what would matter more? Cash hitting your account every month, or the biggest pile 15 years from now? Hold that answer. But first, quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, those income numbers sound like MLPI wins in a blowout, but there's one thing about that $5,400 a month that changes everything, and I'm going to show you exactly what it is. The high-yield ETF income showdown. Let's put the numbers on the board. MLPI pays $65,000 a year. SPY pays $4,600. QQQ pays $2,200. On income alone, this isn't even a contest, but here's where I need you to pay close attention. Before I tell you this next part, take a guess. What percentage of MLPI's monthly payout is actually your own money coming back to you? Not new earnings, not dividends from the companies it holds, your own capital being returned. Take a guess. The answer, according to the most recent NEOS disclosure, is about 87%. 87% of what you're getting paid is return of capital. Now, that sounds scary, but let me break it down because it's more nuanced than most people think. Return of capital means the distribution is not taxed when you receive it. That's the upside. Instead, it lowers your cost basis, the price you originally paid per share. So you defer the tax until the day you sell. For a lot of investors in a taxable brokerage account, especially in the 22 or 24% bracket, that's a genuine advantage. You're keeping more money working for you right now. But, and this is the part most people skip past, it also means your cost basis is shrinking. If the share price doesn't grow enough to offset that over time, you could be slowly getting your own money handed back to you while your investment quietly gets smaller underneath. It's not free money, it's a tax strategy with a built-in trade-off. Big difference. One more thing worth knowing. MLPI issues a 1099, not a K1. If you've ever held individual MLPs, companies like Enterprise Products or Energy Transfer, you know the K1 headache. Some accountants charge $25 per K1. Hold 10 of these companies, and that's $250 just in extra filing costs. MLPI wraps all of those holdings inside an ETF structure, so you skip all of that. So MLPI is the income king, no question, but the crown comes with a caveat. Now, here's the part that might flip your thinking. What happens when you zoom out and look at $450,000 actually becomes in each of these funds over time? The NEOS ETF growth race. Here's where things get interesting. Since MLPI launched in December 2025, and I want to be clear on this because there's a lot of wrong information out there, MLPI launched in December 2025, not 2023. This fund is about 7 months old. In those 7 months, the total return numbers look like this.
MLPI is winning, 20.8% total return versus about 15% for QQQ and roughly 9% for SPY. That's impressive. But hold on, let me be real with you. That's 7 months of data during one of the strongest energy rallies we've seen in years. Oil spiked above $100 a barrel early in 2026. Midstream companies were surging. That is exactly the kind of market where a fund like MLPI looks unstoppable. That's a sprint, not a marathon. Now look at the long-term picture. SPY has averaged about 15% per year over the last decade. QQQ, actually let me be more precise here, QQQ has averaged 21.9% per year over the last 10 years, a total return of over 600%. Those are real numbers backed by decades of data across crashes and recoveries. MLPI can't make that claim yet, not because it won't, maybe it will, but because it hasn't been alive long enough to prove it. So let me think through this out loud. You take $450,000 and compound it at SPY's 10-year average of 15% for 15 years, that gets you to roughly $3.6 million. At QQQ's historical average, we're talking about a completely different number, a number MLPI simply has no track record to match. Quick question before we move on. If you had $450,000 right now, would you take $5,400 a month in cash, or would you let it compound untouched for 15 years? Drop your answer in the comments. I read every single one. So, the index funds have the long-term track record. MLPI has the income. But there's one more thing neither side of this argument ever talks about: the risk. And this next part is where a lot of people get blindsided. Dividend income risk, MLPI's concentration problem. Let's talk about concentration, because all three of these funds have a problem. They're just not the same problem. MLPI is 94% energy, one sector, one bet. QQQ is 57% tech, still heavy, but at least it holds 500 companies across 11 sectors. Now, here's what I see a lot of investors do. They look at SPY or QQQ and say the tech concentration makes them nervous. Fair enough. So they move money into MLPI thinking they've diversified, but they haven't. They've traded one kind of concentration for another. And here's the part that should make you pause. MLPI's worst drawdown since launch is 4.64%. That sounds incredibly safe, but that number only exists because the fund is 7 months old. It hasn't lived through anything hard yet. Want to know what a real stress test looks like for this sector? AMLP, the largest MLP ETF with a long track record holding the same types of pipeline and energy companies as MLPI, dropped 77% in March 2020. 77%. It took 934 trading sessions to recover. That's almost 4 years. And during the 2014 to 2016 energy crash, the broad MLP index fell 58% from peak to trough. I think a lot of people are treating MLPI like it's been battle-tested. It hasn't. It's 7 months old. That's not a track record. That's a first semester. And some of you are going to disagree with me on that. Tell me why in the comments. So now you know the income, you know the growth story, and you know the risk. There's only one question left, and the answer is different depending on your situation. Which fund wins for your 40s? Here's what I'd want to know if I were in my late 30s or early 40s sitting on $450,000. There is no single winner here, and anyone who tells you there is, they're selling you something. The answer depends on the job.
Scenario 1. You need income right now. Maybe you're covering a gap. Maybe you've stepped back from full-time work. Maybe you have a specific monthly obligation. In that case, MLPI earns a seat at the table, but not as your entire portfolio. Think 10 to 15% of your total investments. On $450,000, that's $45,000 to $67,000 allocated to MLPI, throwing off roughly $6,500 to $9,700 a year in distributions. That's real, meaningful income you can feel every month, and the risk stays manageable. Scenario 2, you're building wealth for 15 plus years. You don't need the cash yet. You want the biggest pile when you get there. SPY or QQQ is the engine. Decades of data, hundreds or in SPY's case, 500 of the biggest companies in the world. History is on their side. Scenario 3, and this is the one I think most smart mid-career investors should seriously think about, the hybrid approach. Let me walk through it.
Take that $450,000 and split it. $337,000 in SPY, that's your growth core, about 75%, $67,500 in MLPI, your income satellite, about 15%, and $45,000 in cash or short-term bonds, your cushion, about 10%. That MLPI satellite generates roughly $9,800 a year in distributions, about $820 a month hitting your account. Meanwhile, the SPY core is compounding at historical rates, building the pile you'll need down the road. You get income and growth, and you're not betting your entire future on one sector surviving every oil shock for the next 15 years. That's the real answer to this video's question. Match the fund to the job. That's the whole game. If someone you know just put their entire portfolio into one high-yield fund because the monthly number looked great, share this video with them right now. Here's my question for you. Which scenario fits your life? 1, 2, or 3? Tell me in the comments. And if you're building income from your investments and you want to stay ahead of changes like these, subscribe to this channel. I break this stuff down every single week.